They finally admit red flags for rate cuts, silver headed to drop. Today's numbers show that the economy may not be any place near where the Fed wants it to be. This is important for us as silver stackers, right? This is important for all of us. Just showing you some silver right there, some generic bars. It's important for us because we're enjoying the silver price. We're loving it. We're enjoying this skyrocketing gold price, but that may be all headed for a change. I'm going to break this down for you. Bloomberg tells us U.S. jobs soar again as payrolls jump 303,000 and unemployment drops. This makes a hard case for rate cuts, and in reality, really, what it says is there may not be cuts coming anytime soon. Take a minute to process that and really understand what's going on. This article in Bloomberg says the U.S. labor market appears to be strengthening, not slowing, and risks delaying Fed easing. The labor market has been the stalwart of the U.S. economy, giving Americans the wherewithal to keep spending in the face of high prices and borrowing costs. While Fed officials have flagged moderation in job gains over the past years as a possible precursor to interest rate cuts, today's data may raise questions over the extent of that cooling and its implications for inflation. That's the real nerve-wracking part, is the implications for inflation. This is the balancing act that we are dealing with. Now, the important part here is to know that there's been a continued deceleration in demand. Continued. Demand for the auto industry has been down. Demand for many sectors has been down, even against rising payroll. That's the strange part. And the part of this balancing act is, yes, rising payroll is great. Wages rising up with inflation is great, unless we get to a point where wages actually rise a little too quickly. Then that throws everything off balance. So the Fed loves to tell us that an increase in jobs result in an increase for inflation. That is not necessarily the case. Despite the fact that we've seen revisions often lately, you've seen plenty of revisions. The payroll report continues to print large blockbuster numbers. So why do we continue to receive the deceleration in demand? Why are we seeing? Could it be that people are losing their full-time jobs and picking up another part-time job? That could start to make sense, but there actually is another factor. Bloomberg shows us that an aggregate measure of weekly payrolls, this is according to Bloomberg, an aggregate measure of weekly payrolls, which provides a broader reading of changes in earnings, hours of employment, rose to 0.8%, matching the biggest monthly increase since January 2023. If we look at total compensation, we see a decelerating trend, which means as long as it's going down, payroll will go down. The challenge is that total compensation growth is actually fairly high. That starts to make sense as we see these payroll numbers hold at an elevated level. This, again, is from Bloomberg. Bloomberg says the household survey also publishes its own measure of employment, which surged nearly 500,000 in March after declining in the prior 3 months. Many economists have discounted the recent weakness in this metric, given that other indicators remain strong, such as unemployment claims and consumer spending. That shows that we're seeing a little bit of a bounce back as other economists have discounted the recent weakness in this metric. Of course, you've seen a lot of weakness in spending. We've been waiting for consumers to pick up on spending. And I think that is a real key to what is actually going on in this economy, because employment is up, wages are up, but spending is not where it should be. The article states increased participation may also be helping alleviate wage pressures. The survey of establishments showed that average hourly earnings rose 0.3% from February and 4.1% from a year ago, slowest annual rise since mid-2021. There's an issue here. When we see more participation in the labor market, and that is putting down pressure on wages because more people are applying for the same job, right? Typically, when we see a deceleration in total compensation, we initially see people coming back into the workforce, and that makes sense because households are seeing their income start to sink. The reality is that we're seeing a decrease in demand because yes, people are back at work. Great. That's what we want. They're pushing up the jobs numbers, but inflation is keeping them from making purchases. That's what's really so glaring. Everyone's working, but they're working just to get by. So what it really shows is that this debt economy that we're living in, all this debt that's making people run on a treadmill rather than offering them the opportunity to go out and spend. Everyone's paying off their debt, and you and I, regular people in the trenches working every day, that shows that we are eager to see these interest rate cuts. And as silver stackers, we're anxious to know whether this silver here, whether this silver I'm holding in my hand, that's been performing so well and moving on an upward trajectory finally for the first time in 2 years, all this data points to an imminent correction in the price of metals. And that is really what we have to accept. That we're all so excited. I'll give you some more silver on your screen. I'm supposed to take better care of this silver, right? We're so excited to see silver jump up $27. I mean, come on, we've been waiting a long time for this. But the reality of silver, I have to put this down. The reality of silver is that it corrects, right? We don't just fly high like we see in these images. I mean, silver is going to correct. Gold is going to correct too. And what we see in this data from today is that, yes, more people are working. Great. We want that. But the spending is not happening. People are clearly living like we all are in this debt-based economy. And with this uptick, I mean, the word uptick is really putting it lightly. This serious issue with credit cards, that is just the glare. That's a glaring red flag showing us that, yes, people are working and credit card debt is out of control. People are still turning to credit cards. And even if people are easing back on paying things with credit cards, they're still stuck in that debt cycle of having to pay off the enormous interest, right? We've all been there. We've all been in that position where we convince ourselves, yes, I'm gonna take out this credit card for 0% for 12 months, whatever it is, and then I'm gonna pay it off before that 12 months. And of course, life hits us, and we end up in that cycle of the fluctuating rate, which is just like 23%, enormous. I mean, just killer, right? And that's where many people are at. You combine that with the struggle for regional banks and commercial real estate all coming to roost. Those loans are coming to mature as these months roll out. Regional banks are not going to be able to offer loans. There's no way that everything is going to pop. We pulled out, right? All that government support was pulled out in the past 2 weeks for regional banks. So there's not going to be that support there. And this is what's coming down the pike as the Fed talks about rate cuts in June. I mean, we'd all like to see that as stackers of these precious metals. We all want to see that because that helps the value of our precious metals. But the reality is we'll be lucky if these numbers really can get stronger than we need, right? We already saw in the past 3 days, we've seen the Fed try to pivot and point our direction at the housing market and say, well, don't look too closely at manufacturing because it turns out manufacturing is just barely expanding. Like barely, it was like 50.3%. It's like barely expanding. We need some serious numbers to really show that manufacturing is and the economy with this manufacturing sector is expanding. So just look at the housing. Let's look at all this housing, and that's the game. It's especially in an election year, that's the game, right? We need the economy to look strong, and I get it. I absolutely get it. Every election year, this is what we experience. This is what we go through. But for us, those of us stacking silver, wanting to stack gold, even though gold is just completely out of reach for really all of us. I mean, who's really buying a good amount of gold now? We really have to wait for the correction for gold. And silver, we could still reach for silver, absolutely. $27, even if it goes to $28. I mean, it's still within reach. But this is not the time to buy. I've convinced myself to hold and stop and don't jump in and buy, even though it is so tempting. When we all have this excitement for silver. I have it. And I'm forcing myself to hold off. I did buy silver this week. I did. I'm going to be honest, but I'm going to hold off and I'm going to wait for the correction. It always comes. History teaches us that everything works in a cycle. And when that correction comes and we see a dip again, then that is when I will jump back in. And again, I'm not a financial advisor. I'm just a guy stacking silver, telling you my opinion. But that will be the time to jump in and buy again.